Canada offers a range of investment options to individuals, each with its own characteristics, tax implications, and risk levels. Here's a list of common investment options in Canada with detailed explanations. Stocks, equities. Stocks represent ownership in a company. Investors buy shares of Canadian or international companies listed on stock exchanges like the Toronto Stock Exchange, TSX. Returns come from capital appreciation, rising stock prices, and dividends. Canadian government bonds and corporate bonds are debt securities where investors lend money in exchange for periodic interest payments and the return of the principal at maturity. They are considered lower risk compared to stocks and offer regular income. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. Professional fund managers make investment decisions, providing diversification and expertise. Exchange-traded funds, ETFs. ETFs are similar to mutual funds but are traded on stock exchanges like individual stocks. They offer diversification, lower fees, and tax efficiency. Real estate investment trusts, REITs. REITs are publicly traded companies that invest in real estate properties and mortgages. Investors can buy REIT shares to gain exposure to real estate without buying physical properties. Canadian banks and credit unions offer savings accounts with competitive interest rates. These accounts provide liquidity and security for short-term savings. Guaranteed Investment Certificates, GICs. GICs are low-risk, interest-bearing deposits offered by banks and credit unions with fixed terms. They offer guaranteed principal and interest, making them a safe choice. Registered Retirement Savings Plans, RRSPs. RRSPs are tax-advantaged retirement accounts where Canadians can contribute pre-tax income for long-term retirement savings. Investments within an RRSP grow tax-deferred until withdrawal. Tax-free savings accounts, TFSAs. TFSAs allow Canadians to invest after-tax income with earnings and withdrawals tax-free. They are versatile accounts suitable for various investment options. Registered Education Savings Plans, RESPs. RESPs are tax-advantaged accounts designed to save for a child's education. Contributions can attract government grants, and earnings grow tax-deferred. Stock Options and Employee Stock Purchase Plans, ESPPs. Some employers offer stock options or ESPPs as part of employee compensation. These programs allow employees to buy company stock at a discount or as part of their compensation. High-interest savings accounts, HISAs. HISAs offer higher interest rates compared to regular savings accounts and can be a short-term or emergency fund option. Investors can buy physical gold, silver, or other precious metals as a hedge against inflation and economic instability. Foreign exchange, Forex. Forex trading involves trading currency pairs in the foreign exchange market. It's highly speculative and requires expertise in currency markets. Canadians can explore alternative investments like hedge funds, private equity, and venture capital if they meet specific accredited investor criteria. Before investing in Canada, it's essential to understand the tax implications, risk tolerance, and investment goals. Consider consulting a financial advisor or planner to create a well-balanced investment portfolio tailored to your specific needs and circumstances. Additionally, stay informed about any changes in Canadian investment regulations and tax laws that may affect your investment choices.